Hey, Dan Fitzpatrick here, stockmarketmentor.com. So a few days ago, I posted a question on Twitter asking for responses to what is your most common mistake that you know you're making. And I got so many responses that I thought I would just do a quick video to kind of cover that because I don't like to pose a question and then leave everybody hanging. But it was too voluminous. I mean, it's not like I got thousands, but I think there were close to 100. And I can't respond to every single one individually. But the thing is, I noticed, and this was not a surprise. In fact, I knew that I would get this. I got just a handful of different mistakes. Just seems like everybody makes the same one. And I have recently recorded other videos or classes, whatever you want to call it, on how to spot what your mistakes are and how how to overcome them. So I've already kind of done this, but I thought I'd do it, just kind of specifically for my question. So in a nutshell, and I'm going to show you a few charts, but right now I just ask you to listen to me and see which ones which are the ones that describe you. They all shouldn't, but I think you'll probably find that one or two of them does. So here's the thing: just some of the issues that I have is early selling panic selling part of a newly held position. Too many positions to track. 40 positions in a small account. I'll kind of address some of these as I go. Okay, too many positions in a small account, like 40. That is like way too many. Probably about 90%, at least 80%. This is what you're trying to do is be right. You're trying to be in on every single trade that you're seeing, and you're deluding yourself. There's no way you're going to ever make any headway, even if there's no commissions. You're never going to make any headway when you've got 40 positions in a small account. Frankly, you're never going to make any headway if you got 40 positions on any account. You do need to be concentrated so that one good stock will actually make a difference. Okay, after a big winner, I overtrade. Okay, that's just simply not first of all, it's a common thing. It's like, oh my gosh, I have a big winner, I'm invincible, I want more. I got to do more trades. Oh, this was fun. I just want to get that feeling again. And what that entails is you don't have a plan. You don't have a specific way, a specific methodology for finding stocks that work for you based on what your trading strategy is. I don't care if you're a day trader or a swing trader or a longer term trader. By the way, I'll dispense with this really quickly. Day trading, hey, I'm going to save you a lot of money. After the first hour, you're done. By 10:30, you're done. People spend the first half an hour, 45 minutes, maybe even the first hour making all their money, and then they spend the rest of the day giving it back. At 10:30 in the morning, you are through. That's all I have to say about day trading. Other things is you get out too early. People, you see like, oh my gosh, the stock's working for me, and I'm out. I got to get out of that. One way that you can deal with that is this. Shopify. Okay, you see how like, whoa, this is really brutal. A lot of drawing in there. Well, so this is what I did back in. Let me kind of get rid of this stuff. Back in January, when I put this trade on, I had drawn these lines, and I do this a lot. I just call it envisioning, where I'll look at a chart and say, okay, what will the stock, if the stock does what, then I'll feel like it's a good trade, like I'm on the right side of the trade. On the other hand, if the stock does this, then I'm on the bad side of the trade and I got to get out of it. So when I was first drawing these lines, which was back, when I initially made the trade here, my sense was that if the stock continues to just kind of do this, like this is what I was expecting it to do. I got it. I saw this box here. but I see the longer term trend, sideways consolidation. The box that is being formed or was being formed here looked like it was a potential breakout. And so I thought, as long as the stock, just kind of generally speaking, holds above this level here, 1150, then I'm okay. And so I drew these lines. This is good stock territory. The bad stock is if the stock starts pulling back like this and then ultimately breaks the 50, then I'm going to know I'm wrong. And so I would get out. Well, the stock was playing good stock for a while. If you don't have a plan, if you don't have a structure like this, you're going to sell right here. You're going to see the volume. You're going to see the stock gap up and then reverse, and you're going to say, I'm out of here. I'm wrong. You have to have a plan. Where am I buying? Why am I buying it there? How many shares am I buying? Based on your comfort in the market, your comfort in trading, and where are you going to put your stop? Okay, if I buy right here and I put my stop right there, how many dollars per trade, or excuse me, per share am I going to lose? Okay, multiply that by the number of shares you buy, and you know what your dollar risk is to your account. You have to know this information before you trade. You have to know exactly how many dollars you are risking on that trade. If you don't know that, you're going to get shaken out early. I promise you that. If you don't know. If you do know that, then you can plan accordingly. And one of the adjustments to your plan is, okay, well, that's too much for me to lose. So you either adjust your stop, which you don't really want to do because your stop needs to be based on some kind of chart criteria, or you say, well, I'm just not going to trade that big. I got to drop my position size down. You never want to risk more than, say, 1.5% of your account on any one stock. So if you have $100,000, you should not be risking, you should not be losing more than $1,500 on any trade. And that doesn't mean your position should not be bigger than $1,500. It means that if you are stopped out on a given trade, you should not lose more than 1.5% of your account. Personally, I try to go for even less than that, but some days it doesn't work. But those are the things that you must do. So far, the stock's in the good stock territory. And as time marches on, you see the volumes kind of declining, right? So it's all good. Now it starts to pull down here. Oh, it undercut the 50-day moving average. Well, my initial stop was at, let me get it for you. Yeah, it's still on at 1047. My initial stop was right down here. Again, I bought it here and I based it on a few different things. You'll see, I had a set percent that I was willing to risk. And so on this pullback here, we're not close to getting stopped out. It'd be nice if the stock wasn't doing this, but we're not close to getting stopped out. And here we are. So now we've got a profitable trade. It's not a monster trade. It's up 10%. But the point is, I had a plan, I had a stop, I knew how many dollars I was risking. And so when the stock pulled back into this bad stock zone, it was really still okay because there was enough time that had gone by to where I kind of knew I had a good sense for what the stock was doing, and it never knocked me out. Never knocked me out of this. Now, in hindsight, was this the best trade? It actually wasn't. And here's why. Because I have a plan. I have a process, and this didn't quite fit it. It was a little bit too high above the 50-day moving average. Not, hugely, but 8 or 9%. So it was a little bit high above the 50-day moving average, and I wouldn't exactly call it a squeeze. So I was just kind of trading it in a different manner, and I'm paying for it. So yeah, we're up 10%. Great. But it's been a little bit of a wild ride. So I didn't have, my mistake on this trade was I didn't execute my plan perfectly. I didn't execute my trading process perfectly. If you have a process, listen to me, you must execute it perfectly. Perfectly. Practice doesn't make perfect. Practice makes mediocre, and it takes up time. Perfect practice makes perfect. Look only at charts that look good. If they don't look good, just move on. Be honest with you, I don't know what the hell I was thinking here on this. Again, we're up on this, but I did not execute my process perfectly. You will, if you execute something perfectly, sometimes you're going to lose money. That's just why they call it trading rather than winning, if only. While in our culture, everybody's trying to make it a risk-free life. Own nothing and be happy. Everybody stay inside. Everybody gets a participation award. If you take any risk, it's okay because we'll bail you out. All of that stuff. Trading is not like that. Trading is not like that. It is risky, and you're going to have to pay your dues sometimes, even on the perfect trades. But if you exercise your process, if you execute your process perfectly, at least you're getting in at the right time, at the right stock, and then sometimes stuff happens. DraftKings, we had our plan. This was more of a squeeze, had a nice move to the upside here. Just recently put this back in our active trade list where, by the way, I'm giving you stocks, entries, stops, and how to trade around it. We just took some off the table on our Zoom Info trade. We got this. We're up, I think, a little over 10% in just a few days, which is fine. I personally, I think the stock's going higher. I don't know what that is. Personally, I think the stock's going higher, but when we're up we're up 10% in just a couple of days, I'll take a little bit off the table, but I'll hold the position. All right, well, why am I doing that? Because it's part of my plan. It's part of my plan. My plan has always been to take some off the table if this really runs up. By the way, you see these little lines here? I drew these when we actually took the trade. And my reference here was, hey, this is what I expect the stock to do. Run along here, then get a little retracement, and then I expect it to keep going. I don't know that it's going to do that, but if it does that, I'm good. So I sell into this. Now, if the stock starts pulling back, I'm okay with that because that's what I'm expecting. If I'm not okay with this kind of a pullback, then I need to be selling more right now. If I'm not going to be okay to hold the stock, say, perhaps even to test 50, that's a 10% pullback. But if you're going to make real money, you have to be able to trade through the ebb and flow. You have to. Okay, I had to take a break for just a sec. Somebody was at the door. Anyway, so as long as this does this, as long as it does what I think it's going to do, then I'm okay with that. However, when you're up so quickly, I'm up this much today, you could trade around that. And here's what you got to be looking at on something like that. Okay, the last real sizable low was here. Okay, but there's been so much trading going on. I don't really care so much about that. But this is what I do care about. On the day that we entered, what happened was this big long tail down. It had to do with the company finally closing on some notes that it was selling. And I think what happened is the institutions that were buying those notes could then sell their shares that they owned. And then, boom, the stock went down and then ran back up. So I look at this as a key level here. And so from that, I see the stock is up 20%. Well, this is kind of a modified Bill O'Neill thing. O'Neill used to say that after a proper breakout, if a stock runs up 20%, that's the time when you at least want to be taking some off the table, because that just kind of tends to be how far stocks go before they start their next base. Certainly a general rule. But in this case, when I see how much this is run, it's like you kind of have to take profits. You don't sell it all. If you're selling it all, then you're effectively a very, very short-term swing trader. And then so many times you sell it all, and then a week later or a month later, you look at the stock and it's up 60% higher than when you sold it, and you go, crap, I am a great stock picker, but I really sucked on this one because I sold it all too soon. By the way, this is one of the biggest mistakes, most frequent answers here to my question. I sell too soon. Not having patience on trades. Early exits. Closing calls for a good gain. Somebody's buying calls, but too soon. The price spikes and I missed out on a great trade. I got a good trade, but not a great trade. Basically, that's it on these. Setting a specific price target. And by the way, when you set a specific price target, what you're doing is you're limiting yourself, because the stock's not going to go someplace just because you think it's going to. So it's just really a guess. And so you set it, and then once the stock runs up to that level, you're out. You say, oh, it hit my target. Well, who are you to be making a target? You can do a kind of a guesstimate. But that is, and listen to me here, doing a guesstimate, like I do measured moves all the time, but this is why, because it helps me with my entries. It helps me with some kind of a profit expectation. So I see this stock retraced by 25%, fell about 13 bucks or so from here down to there. And so then I see the breakout here. If I run it up 25%, okay, I get a move to about 62. If I run it up 13 bucks, what do I get? Looking at this here, I get about 63. So what's that tell me? Well, it doesn't tell me anything, but it helps me frame my estimate. And so I'm looking for at least 60 bucks. Now, why would that be important now? It's not. It's important when I actually get into the trade to begin with, because I'm looking at this and I'm seeing, okay, well, this looks like it's breaking out. I wonder how high I could expect it to go. Not when I would sell, but how high could I expect this to go? So that's the type of move that I would measure. And I'd say, okay, well, I think it'd probably go to 60 anyway. Yeah, I bet it'd go to 60 anyway. So the stock's at 50. So I'm looking at a potential for a 20% run from 50 to 60. So we wait. But still, I sold some of my position today because the stock has made this first move. Now, if it pulls back and holds up, I'll be buying that back. That's trading around a core position. People tend not to do that. You just like, oh, that's great. I'm looking for 60, but it's up 55, so I'm going to sell it all. No, you take some profits off the table, which lowers your cost basis in the remaining shares and gives you more cushion. And then ultimately what you want to do is, let's say you've taken, I don't know, easy math. Let's say you've taken $5 off the table. Your stop had been $5 below where your entry was. You took half off the table, so you booked a $5 profit. At that point, you can say, hey, I know what I'm going to do. I'm going to go ahead and raise my stop on the remaining shares that I have so that I'm risking a max of just $1. Or even so, if the stock pulls back, I sell right at where I bought. Okay, what you're doing is then you're locking in a gain. You're locking in a profit on that trade. Or you can, if the stock does pull back, you go ahead and buy some more stock, and then you place a stop on that new position. The idea that you want, and I don't care what your issues are here, what you want is progressive exposure. You want progressive exposure without taking on progressive risk. By the way, this is textbook Mark Minervini stuff. Mark talks about that, about backstopping your trade, about making sure you know exactly how much you're risking. But here's the other thing, and now I'm getting back to this idea about early exits. I sell too soon. I'm always trading out early because I see another stock that looks better, and so I'm never really making any money. These are all answers that I got. With respect to that kind of stuff, if you have your plan, you must fly your plan. It's a basic axiom of aviation. Plan your flight, fly your plan. If you don't have a plan, you will never trade well. You're always going to be sporadic. And here's the thing, it'll be amazing. When the market is really strong, you're a genius. When the market rolls over, starts getting choppy, you're a dunce. Okay? So you must have a plan that identifies what your setup is, like how close is the stock to the 50-day moving average or to prior support. Is the stock in a squeeze? What's my trigger for breakout buys? Where would I put my stop? What's my average position size, et cetera, et cetera. You have to have all of those things as a part of your plan, okay? And then you have to stick to that plan. This is the problem. People, this is the most common mistake boiled down. You either don't have a trading plan or you have a trading plan, but you don't stick to it. Now, am I describing you on that one? If you're a member of Stock Market Mentor, you absolutely have a trading plan. I harp on this every stinking day. You have a trading plan, and I show you what mine is. I lay it out on all of my trades. We're trying for repeatable things here. So you have a plan, but the question is, do you stick with it, or are you a, oh, this time is different trader? You have to get past that, and that's a really, really difficult thing for people to do. I'm just telling you this. If you ever want to make big money, you must stick with a sound trading plan. Having a plan is not enough. It's like the old saying, deeds, not creeds. Deed, not creed. In other words, I don't care what you say. I care what you do. I don't care what you plan. I care how you execute that plan. So that's the biggest thing. Also, you have to write it down. You have to write down that plan on any given stock. Before you get into the trade, you write down wherever you're going to write it. Get a tattoo. You write down, I will not sell this stock unless, write down a price. And as you're looking at the trade, you say, okay, if the stock hits that price and I sell it according to my plan, you know, I'm taking a loss or whatever, is that loss okay for me? And if it is okay for you, then what you need to be doing, you need to be looking for the loss. You need to be biased in favor of being wrong. You need to say, I have my plan, and my plan is that if I lose X amount of dollars, that's all I'm going to lose. And so you need to have an expectancy that you may actually lose that amount of money, and it has to be okay with you. Not going to make you happy, but it has to be okay with you. If it's not going to be okay with you, then either don't take the trade or just trade smaller. But it has to be okay. And as long as it's okay initially and you have written it down, then go ahead and set a stop and then ignore the position. Set alerts on the upside too. So you know, like, hey, I had a couple alerts firing off today. You know, I had one of them fire off when the stock ran above 55.60. That was yesterday's intraday high. I just wanted to know. And so you're doing these types of things. They're all enabling you to stick to your plan. And if you're doing that, yes, you're going to take some losses. That's just trading. But if you have a sound strategy, you're ultimately going to be in the right stocks at the right times. The other thing is anticipating breakouts. People get this magical thinking, and they think that they see something like, oh, this is going to break out. I mean, you look at this here. Okay, sure looked like it was going to break out here, but it didn't. It ran up to 50 and then reversed. Okay, oh, this is definitely a breakout. I'm definitely buying this stock here. It's almost ready to break out. The high was even above 50. I'm buying it. Okay, well, that didn't work out too well for you because at some point the following day, it fell clear back. So this is anticipating a breakout. Sometimes you can do it, but typically not. And then you're still sitting here a couple days later, and so what are you doing by this day? You're going like, crap, I anticipated the breakout, exactly what Fitzpatrick told me not to do. I'm going to go ahead and sell this thing. Oh, I'm such a dunce. Now the stock does break out. It holds above 50. You're in, or you would have been in, and now it's up here. This is all a big mistake of just not having a plan. And the other thing is emotions. If you are an emotional trader, you are trading too big. You're trading too big. If you're getting emotional, that's the one way you fix that is trade smaller. Lower your position size, and you're going to do fine. The other thing is, and that's just an emotional thing, by the way. The other thing is, like, I look at closing bell, baby, and I've done okay today. Um, I look at stocks in 2 time frames. I mean, ultimately I look at them in more than 2, but this is how it works. I'm looking at a weekly chart. Like, this is how I first looked at Zoom Info, and I'm seeing the stock. This is a new trade for me. So I'm seeing the stock, how it's looking here on the weekly chart. And then fine. So I see it, it breaks out sometime today or sometime this week. Okay, great. I'm in the stock. It was this chart here that led me to my decision to buy the stock. Weekly chart, my decision. I want to own this stock. Okay, so what do? I move to the daily chart to actually take action. Like, I've made my decision. I want to buy the stock if it breaks out above 50. Definitely what I want to do. I've decided, but I'm not doing it because I'm waiting. And then finally, I'm buying the stock here. And then as soon as I'm buying the stock there, I'm zooming back out to the weekly chart so I don't do anything stupid. Okay? It's decision, action, time frame, and then as soon as you take action, boom, it's back to decision. Now, you can say, well, wait a minute, Dan, you just told me you sold some of your stock. Yes, and that's part of the plan. That's part of my plan is if it runs up quickly, I'll take some off the table to give me more staying power, to give me more holding power. Now I'm a stronger trader because I've already got some profits. I've already got some profits built into the trade, and I feel better about it. And it all starts with the decision, action, time frame. Okay, so anyway, I hope this helps. I could go on and on about this stuff, but it really all just boils down to the same thing. What's your process for entering? And don't anticipate it. What do you need to see for a setup? And then once you have your stock lists of setups, what do you need to see to actually take action on the stock? And think about it this way. If a stock is almost giving you that trigger, how much are you getting? Like, what is your advantage by buying just a little bit before the trigger? 0.5%? 1%? How many dollars are you do you stand to make by buying a little bit early rather than waiting for confirmation that the trade is going to work? Typically, the answer is I don't get that much of an advantage by anticipating a move that makes me feel like I want to go ahead and take that extra risk. Wait and trade what you see. You got to just know what you're watching. So what you're watching for. Anyway, so look, I hope this helps. This is the kind of stuff we talk about all the time at Stock Market Mentor. If you're a member, you know this. But we're really making good traders over there. And we're walking traders all the way through these trades. Like, this is just something from the forum today. What I was mentioning on ZI, this is exactly what I was talking about today. It's just telling, so okay, go ahead and get out of this trade a little bit. Here is another, these are just posts from today, from today's forum. One of our members was really struggling before he came here, and then really had a disastrous 2019, lost 50%, over 50%, and by the end of last year, recouped them all, up 12%, and now already up 20% this year, and self-aware. I still make mistakes. So what I'm saying is, if you're looking to fix some of these mistakes, it's fine to hear me yammering on for half an hour about it, but I can help you fix them just by the repetition in the market, in real-time trading, in video tutorials every night. So if you are a member, look, you know all this. If you're not a member, try it for 30 days. It's on me. It doesn't cost you anything, okay? All right, thanks. And by the way, I appreciate everybody on Twitter who did respond to me. I don't follow that many people because personally I think Twitter's a cesspool. But if it's just about market stuff, I'm your huckleberry, okay? All right, see you guys.